Hello again, everyone. It's been a while since I've recorded. I've been a little lacking in the enthusiasm department. I haven't had anything to say to you, but I do now. There's been some things piling up in my inbox pertaining to low volatility investments. I've also read some articles about low volatility investments, and it inspired me to want to share this with you today. The subject is not just no pandering, which we're going to talk about, but it's also about volatility. Volatility, just so we're all on the same page, is all up and down movements in securities prices. However, the media has primarily attached the term to only the down sharp movements in securities prices. But we all love part of the volatility. We like the up volatility, we just don't like the down. So we just have to be clear on that. Why would anyone put up with volatility? For the simple reason that it's in our interest to put up with it. Investors have tended to be well rewarded for putting up with volatility. And so I want to speak to a little bit to that today. Now, I want to quote the esteemed Nick Murray again, as I do frequently. It would be nice in a perfect world maybe not to have to deal with volatility in investments, so they just went steadily up all the time. Just like it'd be nice to be able to eat all the sugar that we would want to eat and to draw checks on bank accounts with no money in them. All that would be great. However, we know that there's negative consequences attached to a lot of these things. If we ate all the sugar we wanted to eat, we would grow morbidly obese and die. If we drew checks on banks with no money, we would be bankrupt. In the same way that if we eliminate volatility from investments, we will tend to suppress returns. History shows us that. In other words, our returns are going to be less than if we just put up with it. Okay? And so this is a very important topic because furthermore, to suggest that we could suppress the volatility without suppressing returns would then suggest then that the markets are inefficient, which we know that they are not. It would also suggest that we can time the markets, which we know we cannot. The Wall Street Journal cooperated beautifully with my reporting of this today, as just yesterday they had a front page article, I'm going to come closer to the hedge fund bets, hits, pensions, talks about a number of pensions that went into some hedge funds that, it says firms move portfolios away from stock market to reduce risk, but missed out on rally. So they move away, and lo and behold, the darn market went up anyway. So this is exactly what I'm talking about. There's lots of examples to this. Now, in my opinion, people who profess the ability to do this, to suppress volatility, know that it's not true, and in my world, that's called pandering. If we take it further, if they're doing something that they know they can't carry off consistently and reliably, I also think it's evil and morally wrong. So that's where I stand on it. There is a beauty in volatility because it is in volatility where the returns come from. And that's what I'm always trying to coach you all to be aware of. Volatility is just the market's beautiful way of rewarding investors for putting up with it. Now, we always need to be aware. There always has to be the compliance moment of one of these videos, and that is you need to be aware of the potential risks of volatility. I'm constantly teaching that. If you feel like you're unsure, please make sure you talk to me about that. And staying invested is a great option as long as you're confident in your strategy. So if you're having anything invading your mind space on your strategy, please make sure you mention that to me as well. Because all investing does involve risks, and no strategy is guaranteed to produce a return, particularly in the short term. Now, next time, tune in. We're going to have a little bit of fun looking at one of the things that can challenge us, particularly in times of market volatility, which is the 24/7 financial news cycle. Until then, thank you.